Today I have a guest with me. His name is Sam Parker from mycreditguy.com. How you doing, Sam?
I'm good, Scott. Thanks for having me. How are you?
Good. I'm excellent. I am excited to talk to people about credit scores. One of the unique things about what we do at Find My Way Home is, now we were just talking, you work mostly with loan officers. You don't work a lot with consumers directly, but when a loan officer like me has a client who has some issues with their credit, I'll reach out to you. You're kind of my specialist, my sniper, my special ops guy out in the field. It's like I have a mission and I need you to go out and help. But one of credit is one of those interesting things, is that there is a lot of bad information out there. There's a lot of scams. There's a lot of bad information about how credit works. And my goal here is to expose people like you to consumers. And the difference of what we're doing here and you going out and trying to get this information on your own is, if you call somebody, they're going to try to sell you a package. Sam and I are just talking. We're old pros. We're veterans. We're just we're in the trenches talking about our near misses and our successes. And so hopefully from having this conversation, you're going to have a better understanding about these things and you can go out and make more informed decisions. So understanding credit scores, what the heck is this credit score thing here, Sam, and what do I need to know about it? How do you explain a credit score?
Yeah, well, so a credit score is basically an algorithm that determines how risky you are to lend to, the probability that you'll pay back the money, the probability that you won't, and then it's computed into a credit score and then sold to lenders and banks so that they can make a decision as to whether or not they want to lend you their money. But that's one thing that you got to understand, because as we're going through the credit score, there'll be things that happen that people be like, that doesn't make any sense. Why would that do that? Or that increase my score, or that decrease my score, or why don't I get rewarded for this? And you got to remember, it's kind of a negative model, meaning it's a risk-based model that is just there to determine, how likely you are to not pay the debt back. And then they assess a number to it, and that's your credit scores.
Now, there isn't one model, right? There isn't one credit score. So, one of the things that I see all the time are you've got these companies out there now that'll give you free credit scores online. What is that all about? Are those accurate? Is that my actual credit score?
Well, that's all, I guess, in the eye of the beholder. What I consider the end-all, be-all score is your mortgage credit score, because that's the biggest purchase you're ever going to make, and it's the most important one. So in that scope, or that way of looking at it, no, the other ones that you're pulling are not your real scores, because they're going to be on different either versions or models. And what I mean by that is you're usually going to be looking at one of two different models, and that's going to be either your FICO score or a Vantage score. Okay. The FICO, now we're in the right family, at least, of what the lender uses. However, you might buy your FICO score from an online, source, or you might go and have your credit pulled for an auto loan or something like that. And they might say, hey, we're pulling your FICO. But what they don't tell you is that there's all these different versions of the FICO credit scoring model or algorithm that are released in different models that different industries use that take into account different factors. Same thing with Vantage. When you go over outside of the FICO family, and now you're talking about Vantage, again, totally different company now, totally different algorithm, and that thing has different models too. So a lot of times you'll go and you'll pull your credit score online, and you're pulling maybe FICO version 3 when your lender is looking at FICO version 8. Or you're pulling a Vantage score and your lender's not looking even at that same algorithm in any of its form or format. So you do just need to be careful. I will say that I know of, and I've been doing this for 15 years now, that I know of, there isn't a way for a consumer to pull the true mortgage credit score that a mortgage loan officer will pull. It's just not available to the consumer out there. So in some cases, it is going to behoove a client, in a lot of cases actually, to just go to a lender that you trust, that you've been recommended to, and to have them pull credit. So at least you know what you're actually dealing with. But otherwise, you just need to be wary and know that what you're pulling online, you might get a general idea of where your credit is, whether it's good, bad, excellent, but you can't, to the point, actually pay too much attention to the ones that you're pulling online.
My experience with that has been that if you have really, really good credit scores with one of these free companies, that's an indication that you do a pretty good job of maintaining your credit. But I have found that if the scores are a little bit lower on a free credit report, they're usually about 25 to 30 points higher than what a mortgage credit report would be. What I find is they don't show the negative, because I mean, let's face it, they're business models. So they don't necessarily want to tell you, you have horrible credit, you don't qualify for anything. And it's to their advantage to say that you have a better credit score than you don't, because of where your information is going probably after you get your free credit score, right? So hopefully we all know how these things work online now, and there's no such thing as free. So you've got this credit score, and you say it's an algorithm, and you say it's a risk model. How exactly are they calculated? What are they looking at? Are there because I know we have people with student loans, we have people with car loans, we have people with credit cards. How are those used to calculate the credit score?
Oh, okay. Yeah. So basically there's a pie chart, okay, that breaks down the credit scoring algorithm. And I could go on for hours about each one of these, but I'll try to keep it pretty short and sweet. But so there's 5 different sets of data that they're looking at, okay? And it goes anywhere from 10 to 35% based on which section of the pie we're looking at. So let me go through these with you. So new credit is going to make up 10% of your scoring algorithm, and that really is mostly talking about inquiries and how recently credit score or how recently an account, if you have lots of new accounts, okay. 10% is going to be the mix of credit. Oh, go ahead. Sorry.
No, go ahead. I'm kind of following you on this. I have some questions, but I'll reserve them for the end.
Okay. So 10% is going to be new credit, and that. So if you looked at your overall credit score and we're like, man, why are my scores so low? Okay, so 10% new credit, and that's where inquiries fall into. So a lot of people are going to call me and they're going to say, oh, my credit's so low. I know why. It's because I went and I applied for an auto loan, and they pulled my credit 4 times. They're only supposed to pull it once. That's why I'm at a 502. Well, first of all, no, that's not the way it works. The inquiries did not drag you down 200 points. And just know that that section only makes up just a small piece of the pie. So that's why it's important to kind of understand that this breakdown of the scoring.
So out of 5 pie slices, new credit and credit inquiries makes up for about 10% of the scoring.
10%. Yep, exactly. So then you got mix of credit also. And that makes up for credit score, but that can also cause some other problems. And let me explain. So mix of credit means that they want you, like I had talked about before, they want you to have a proper mix of installment debt and revolving debt. Because again, this is a risk-based model. And what they want to see, they kind of want to see you do tricks almost. They want to say, okay, let's see how you handle a credit card. And then they say, go. And then they say, let's see how you handle an auto loan. Go. And they want to see how you perform in the different formats that you can take debt on. And so that's why it's important to have that proper credit mix. But here's another thing that will happen. If you have, let's say that you got a nice, healthy amount of installment debt. So you got a mortgage, you got a student loan, and you have a car loan. You could still technically have a no score. at 0, it means that the credit scoring algorithm is not going to generate you a score because you're not playing by their rules. You don't have a proper mix of credit. So watch, that same person goes out and they add 1 or 2 credit cards, and the next month, boom, there's your 698 credit score. So it was
diversify your debt load.
You really do have to. You really do have to. You just got to show them. It's kind of like, hey, look what I can do. I can handle an auto loan. And then, hey, over here, did you see what I did last month with my credit cards? How I paid them on time and everything, and I have them open. I'm doing what you guys want me to. And then they go, oh, thank you for doing that, and you can have a good credit score. So you just got to, again, people say that's not fair. I don't want to do that. And here's what I say is, you only get to make the rules when you have the $400,000 in the bank that you want to borrow for the home.
You don't need credit.
Yeah, exactly. If you want my money or if you want a bank's money, you're going to play by my rules or the bank's rules. Yeah. You don't get to come to me and borrow my money and then tell me how it's going to work. So that's kind of how it works. So 15% of your credit scoring algorithm is going to be based on length of credit history. That's why you never want to close out a credit card, or during the loan process, you don't want to pay off an auto loan. You don't want to make the last payment on a student loan, because when you make the last payment on an installment loan, like a student loan or an auto loan, it's going to automatically close that account out. And when an account closes, okay, it's not like you got credit. Let's say you've had an auto loan for 5 years. It's not like you got 5 years worth of credit and then you're just not going to get it going forward. They take that length of credit history and they throw it out the window like it never happened. So you don't want to close anything out. You don't want to close credit cards. You want to show a nice long resume. Again, I reference resume a lot. Your credit is your financial resume. When I'm going to hire somebody, I don't want the person who has been at this place for 2 months, and then this place for 3 months, and then this place for a month, and then this place for 6 months. I like to look at it and see, wow, you were there for 2 years. That means you're probably going to be with me for 2 years at least, right? Yeah. And so that's what that length of credit history is showing, is loyalty. How long are you going to keep an account open? This is the
percentage of the pie is that?
15%.
Okay.
Yep. This is the one that seems a little bit like extortion, honestly, to me, because it's like, well, why would I can show positive pay history and that I know what I'm doing without having to keep this account open and keep paying you money. But they have their reasons, and they say that's not what they're doing. But again, I don't make the rules, and neither does the consumer. And so we just have to play by them until we have all that money in the bank to make cash purchases. So 15% length of credit history. 30% is basically how much you owe, or your credit utilization. That's where your credit cards are really going to come into play. I mean, this section, is made up. It's almost all about your credit cards and what I call your balance to limit ratio. Meaning, if you have a credit card and it's $1,000 limit and you're using $900 of it, you're at a 90% balance to limit ratio or utilization ratio, and you're killing yourself. Because the credit scoring algorithm really wants you to stay under 50% for sure. Once you cross over that 50% threshold, you can basically turn it into more of a negative account or a liability than it is a positive account, because you're throwing up red flags that you need credit, that you don't have cash. And so it's kind of a damned if you do, damned if you don't situation, where you got to use your credit, but if you overutilize it, then you're going to lose scores too. But really, this section of the credit scoring algorithm, the 30%, really is almost entirely in reference to revolving accounts and your credit utilization. Ideally, folks, I want you to keep your utilization somewhere between 5 and 10% consistently. Credit cards are not money. And so you'll see your scores fluctuate a lot as you increase your balance and your balance to limit ratios on your credit card.
I've seen huge swings in credit scores just by paying down balances on revolving debt. So that's 4 pieces of our pie. What's the last one?
Last one is your payment history, and that basically just comes down to, do you pay your bills on time? Do you have late pays on your credit? Did you let things go to charge off, to collection status? Do you pay? When you open an account, do you pay, and do you pay on time? And to that, on that note, there is no such thing as one little late pay. I know some consumers will call us and they'll say, oh my God, I had a 720. I added one little late pay on my mortgage, and now I'm at a a 640. And it's like, you're lucky you're at a 640. I've seen it drop more than 100. And one thing that people need to understand is as your credit gets better and better, it's kind of built, if you envision like the Eiffel Tower, right? Like a big base at the bottom and then skinnier and more fragile at the top. So the higher your credit scores get, the more that one little late pay that you called it is going to impact your credit. So somebody with a 720 adds a late pay, it's going to drop them huge amounts of points, 60, 70, 80 points. Somebody with a 620 adds a late pay, might drop them 15 or 20 points. So you just got to really be cognizant of paying your bills on time, get on auto pay if you need to, but never miss a payment because you'll absolutely crush yourself. And I know that sometimes, Scott, and you can tell them this better than I can, I know that when it comes to the mortgage world, if you had a late pay on a mortgage account, then you're probably disqualifying yourself from qualifying for that new mortgage for up to 12 months in a lot of cases.
Yeah. There are some situations where you can have 1 times 30, but there's a lot of splaining to do, and there has to be what they call compensating factors. So you have to show that there was a reason. Now, okay, that's a lot of information, and since we're talking about pies, we're going to wrap this up real quick. But what I want to leave everyone with is there a perfect recipe for if you were building your credit from the ground up, or you're looking at it and you said you've got new credit lines, you've got old credit lines, we have some installment debts there, we have some revolving credit lines there, and then we have our pay history. What is a perfect recipe for installment debts, bringing on new credit, hanging on to old credit? Is there kind of a best practices for optimizing your credit score?
Yeah, I mean, I would suggest, and so to answer your question, I don't know of the perfect mix, but what I have seen in my experience is if you have 2 or 3 installment lines, which most people have in our country, they're usually going to have a student loan, an auto loan. Yeah, exactly. And then eventually a mortgage loan, and then, 3 or 4 credit cards and I say this cautiously, but at least, because there's, some people will say, and there's financial gurus that'll say, cut up all your credit cards. Well, again, we know what that does to your scores, but some people will say there's too many. Sometimes there's too many credit cards and that hurts your scores. That's not true at all. I mean, if you could maintain them and play the game with them, if you had 20 credit cards with all, 5% utilization on them and you're making on-time payments, I mean, your score is going to be at 820. It's going to be amazing because you're going to have all of these, tons of pay history, tons of available credit. Your balance to limit ratios are going to be low. You get rewarded per, individual account that you have open and are maintaining. But the problem lies where a lot of people, once you get over that 3 or 4 credit card and 3, installment loan, that's just a lot to keep track of. So I say, the proper, the healthy balance between not only a qualifying mix of credit, I guess I would say qualifying instead of perfect, and then also the number of accounts that somebody can maintain without adding a late pay by accident. I would say 3 to 4 of each type of account is going to be very healthy. But honestly, you can get away with like 2 installment accounts and then 2 credit cards too, and have a very good credit score. But I would just suggest getting more into that 3 installment, 4 credit card range.
Let me ask you this. Once I have that recipe is what I'm calling it, I guess. So once I have 3 or 4 revolving credit lines and I have a couple of installment debts, is there any need for me to go out and take out new credit lines? I mean, will it hurt me to not take out new credit lines?
Nope. Okay. I mean, ideally I would have, the same credit lines I've had for the last 20 years. And if I don't need a new credit line, then there's not a reward for taking out a new line of credit unless it's in some way improving your balance to limit ratios or something like that, going into another factor. But in terms of getting a new open trade line, if you already have all the qualifiers, there's nothing that goes like, yes, good job on getting a new one or anything like that, Okay. Well, I think that's it. I want to wrap that up. That is a great tutorial, a great understanding of what credit scores are and how they work. I really appreciate your time,
Sam. You're a great guy. I love supporting entrepreneurs, but more importantly, I love supporting people who are ethical and professional in what they do. And I think you epitomize that. So I appreciate you being here, and I look forward to covering some more topics with you about credit.
Awesome. Thanks, Scott.